Most traders believe the secret to success lies in winning more trades. They chase accuracy, search for the perfect setup, and obsess over avoiding losses altogether. Yet the market quietly rewards a completely different behavior, one that feels uncomfortable, counterintuitive, and emotionally challenging for the unprepared mind. The truth is, the market does not punish you for losing. It punishes you for not knowing how to lose. Every consistently profitable trader has learned something that struggling traders resist with every emotion in their body. Losses are not the enemy. Large, emotionally charged losses are. The difference between failure and consistency is not how often you win, but how well you accept small losses without hesitation, justification, or emotional attachment. Losing small is not a money management trick. It is a psychological achievement. It represents clarity, discipline, and trust in probabilities. It is proof that a trader has stopped fighting the market and started flowing with it. Until a trader fully accepts small losses as a normal, expected cost of doing business, consistency will always remain just out of reach. Most traders experience a small loss as a personal judgment. It feels like evidence that they were wrong, careless, or incapable. Even when the loss is planned, predefined, and technically perfect, something inside reacts as if a mistake has been exposed. This reaction has nothing to do with the market. It comes from conditioning, years of associating losing with failure, punishment, and inadequacy. Until this conditioning is dismantled, a trader cannot understand why small losses are not a problem to eliminate, but a behavior to master. In reality, a small loss is one of the clearest signs of discipline a trader can demonstrate. It proves that the trader respected uncertainty instead of denying it. The market never promises outcomes, it only offers probabilities. Every trade, no matter how well structured, carries risk. Accepting that risk up front and acting decisively when the market invalidates the idea is not weakness, it is psychological strength. The trader who exits quickly and cleanly is not admitting defeat, they are honoring reality as it unfolds. Failure in trading is not defined by losing money. Failure is refusing to act when conditions change. Failure is holding on, hoping, rationalizing, or moving a stop because the ego cannot tolerate being wrong. A trader who takes a small loss has already separated identity from outcome. They are no longer trying to be right, they are trying to be consistent. That distinction is where professionalism begins. The market continuously tests a trader's beliefs. One of the most important beliefs is whether a loss threatens self-worth. If it does, the trader will unconsciously avoid small losses because they feel too painful. Ironically, this avoidance leads directly to large losses. When exiting feels like failure, staying in becomes an emotional necessity. The trader is no longer managing risk, they are managing self-image. This is how a manageable loss turns into an account-damaging event. Disciplined traders do not experience small losses as emotional events, they see them as neutral feedback. The trade idea did not work within the expected parameters, so the position was closed. There is no drama, no self-talk, no need for explanation. This neutrality is not indifference, it is acceptance. Acceptance that uncertainty is not a flaw in the market, but its defining characteristic. Small losses also represent commitment to a process, rather than attachment to outcomes. A process-driven trader understands that consistency emerges from executing an edge over a series of trades. Any single trade is insignificant in isolation. When this belief is fully integrated, exiting a losing trade early becomes easy because the trader's confidence is rooted in long-term probabilities, not short-term validation. The loss is simply one data point in a much larger sample. Undisciplined traders often claim they accept risk, but their behavior reveals otherwise. They may define a stop but hesitate when price approaches it. They may exit, but immediately re-enter to get back what was lost. These reactions expose a belief that losses are abnormal events rather than expected costs. As long as losses are seen as something to avoid emotionally, discipline will always collapse under pressure. True discipline is not willpower, it is alignment. When a trader truly believes that small losses are necessary and beneficial, there is no internal conflict when taking them. The action feels correct, not forced. This is why discipline cannot be faked for long. If the belief system rejects loss, behavior will eventually betray intentions. Consistency only emerges when beliefs and actions are in harmony. Small losses also protect something more valuable than money: psychological capital. Every time a trader holds a losing position beyond their plan, they experience stress, fear, and self-doubt. These emotions accumulate and distort perception. After enough emotional damage, even good opportunities are missed or mishandled. By contrast, taking small losses preserves clarity. The trader remains calm, focused, and capable of responding objectively to new information. The paradox is that traders who fear small losses often experience the most pain. They endure large drawdowns, emotional exhaustion, and loss of confidence. Traders who embrace small losses experience frequent but mild discomfort, followed by stability and growth. The market does not reward comfort-seeking behavior, it rewards adaptability. Small losses are the price of remaining adaptable. Another critical insight is that discipline is visible only in losing moments. Winning trades feel good regardless of skill. Anyone can appear confident when the market moves in their favor, but when the market invalidates a position, that is when discipline is revealed. The trader who exits without hesitation demonstrates mastery over impulses. The trader who freezes or fights reality exposes unresolved fear. Small losses are also proof that a trader is not trying to control the market. Control is an illusion that leads to overconfidence and denial. Disciplined traders understand they control only two things: entry criteria and risk. Once in a trade, the market decides the outcome. Accepting a small loss is an acknowledgement of this truth. It is humility expressed through action. Many traders intellectually agree with this concept but emotionally resist it. They say they understand the importance of small losses, yet still feel frustration, anger, or disappointment when they occur. This emotional response is a signal that deeper beliefs need to be examined. The goal is not to eliminate emotion, but to reduce its influence on behavior. When a loss no longer triggers self-judgment, discipline becomes effortless. Over time, traders who consistently take small losses develop trust in themselves. This trust is not based on winning, but on reliability. They know they will act appropriately regardless of outcome. This self-trust is far more powerful than confidence built on profits. Profits fluctuate. Disciplined behavior can be repeated indefinitely. The market responds favorably to those who can repeat correct behavior under all conditions. Eventually, a shift occurs. Small losses stop feeling like setbacks and start feeling like protection. They represent survival, longevity, and readiness for the next opportunity. The trader no longer measures success by daily results, but by quality of execution. At that point, discipline is no longer something the trader tries to maintain. It becomes who they are in the market. This is why small losses are not failure. They are evidence that the trader has accepted uncertainty, released ego, and aligned with the realities of probability. They prove that the trader values consistency over validation and process over pride. In a business where most people are emotionally unprepared, the ability to lose small is not just a skill, it is a competitive advantage. When this understanding is fully integrated, the market stops feeling hostile. Losses lose their emotional charge. The trader operates with clarity, patience, and resilience, and almost quietly, without force or struggle, profitability begins to emerge. Not because losses disappeared, but because discipline finally took their place. Every trader enters the market with the same unconscious desire: control over outcomes, control over risk, control over uncertainty. From the very beginning, the mind searches for certainty in an environment that offers none. Indicators, strategies, news, and opinions are often not tools for probability, but attempts to eliminate the discomfort of not knowing. Yet the market has no obligation to conform to expectations, and it never will. The moment a trader understands this, not intellectually but emotionally, everything begins to change. The market does not respond to force, prediction, or emotional insistence. It responds only to participation aligned with its structure. Prices move as a result of collective behavior, not individual conviction. When traders try to control outcomes, they unknowingly place themselves in opposition to this reality. They fight price action, argue with losses, and interpret randomness as personal injustice. This internal struggle is not visible on a chart, but it is always reflected in inconsistent results. Acceptance is the recognition that uncertainty is not a flaw in the market. It is the market's defining feature. Every trade exists within a range of possible outcomes, none of which can be guaranteed. Acceptance means embracing this uncertainty without resistance. It means entering a trade knowing that it may fail, and being completely at peace with that possibility. This state of mind removes fear, because fear only exists when there is something to protect, usually ego or expectation. Control, on the other hand, is rooted in fear. The need to control comes from the belief that a negative outcome threatens something essential, identity, confidence, or self-worth. When traders attempt to control the market, they are not trying to manage risk. They are trying to avoid emotional pain. This is why control manifests as overanalysis, hesitation, moving stops, or refusing to exit. These behaviors are not strategic, they are psychological defenses. The market consistently rewards those who accept its uncertainty because acceptance allows flexibility. A trader who accepts uncertainty can respond quickly when conditions change. They do not freeze, argue, or hope. They act. This responsiveness is what creates consistency. The trader is no longer emotionally invested in being right, so there is no internal conflict when the market proves them wrong. Execution becomes clean and precise. One of the greatest illusions in trading is the belief that more knowledge leads to more control. While skill and understanding are essential, they do not eliminate randomness. Even the best setups fail. When traders believe their analysis should produce certainty, every loss feels unfair. This belief creates frustration and erodes trust in the process. Acceptance dissolves this conflict by aligning expectations with reality. Acceptance also transforms how traders experience losses. A loss is no longer a rejection, it is information. It communicates that the conditions for the trade did not unfold as anticipated. There is no emotional charge attached to this message. The trader receives it, responds appropriately, and moves on. This emotional neutrality is not indifference, it is clarity. Clarity is impossible when the mind is busy trying to control what cannot be controlled. Traders who seek control often mistake confidence for certainty. They believe that confidence means knowing what will happen next. In truth, confidence comes from knowing you can handle whatever happens next. This distinction is critical. When confidence is rooted in acceptance, it becomes stable and resilient. When it is rooted in control, it collapses the moment the market behaves unexpectedly. The market punishes control through inconsistency. A trader may experience periods of success, reinforcing the illusion of control, only to give it back when conditions shift. This cycle is emotionally exhausting. The trader oscillates between hope and despair, certainty and confusion. Acceptance breaks this cycle by removing the need for emotional confirmation. Results become smoother, not because the market changed, but because the trader did. Another consequence of acceptance is patience. When traders are no longer trying to force outcomes, they wait for their criteria to align. They do not chase price or manufacture trades out of boredom or fear of missing out. Patience is not passive, it is selective engagement. The trader understands that not trading is also a position, one that preserves capital and clarity. Acceptance also enhances discipline. Discipline without acceptance fails like suppression. The trader follows rules but with internal resistance. This resistance eventually manifests as impulsive behavior. When acceptance is present, discipline feels natural. The trader is not restraining themselves, they are aligned with their understanding of probability. Actions flow without friction. The irony is that traders gain more influence over their results by relinquishing the desire for control. By accepting uncertainty, they manage risk effectively. By managing risk, they survive long enough for probabilities to play out. Survival is the foundation of profitability. Control-seeking traders focus on winning, acceptance-based traders focus on staying in the game. The market rewards the latter. Acceptance also protects emotional energy. Trading requires sustained focus and clarity. When energy is wasted on frustration and resistance, performance deteriorates. Acceptance conserves this energy. The trader remains calm, objective, and present. Decisions are made from observation, not reaction. This state of mind is subtle but powerful. Over time, acceptance reshapes identity. The trader stops seeing themselves as someone who predicts the market and starts seeing themselves as someone who executes a process. This shift reduces pressure and increases consistency. The trader no longer needs the market to validate them. They validate themselves through disciplined action. Control, by contrast, creates dependency. The trader's emotional state becomes tied to market outcomes. Wins create euphoria, losses create despair. This emotional volatility mirrors account volatility. Acceptance stabilizes both. Emotional neutrality leads to consistent execution, which leads to more stable results. The market will always be uncertain. No method, system, or insight can change that. The only variable a trader can truly control is their response. Acceptance is the foundation of this control, not control over outcomes, but control over behavior. This is the only form of control that matters. When acceptance is fully integrated, trading becomes simpler, not easier, but clearer. The trader knows their edge, defines their risk, executes their plan, and accepts whatever outcome follows. There is no struggle, no negotiation, no emotional residue. The next opportunity is approached with the same clarity as the first. This is why the market rewards acceptance, not control. Acceptance aligns the trader with reality. Control fights it. One creates flow, the other creates friction. In a probabilistic environment, alignment always outperforms resistance. And when a trader finally stops trying to control the market in its own way begins to work with them instead of against them. Most traders believe their primary objective is to protect money. They obsess over drawdowns, percentages, and account balances, assuming that financial loss is the greatest threat to success. Yet long before an account is damaged beyond repair, something far more valuable is usually depleted: psychological capital. This is the trader's ability to think clearly, remain emotionally neutral, and execute without hesitation. When this internal resource is compromised, no strategy, no matter how sound, can function effectively. Psychological capital is not visible on a statement, but it governs every decision a trader makes. It includes confidence rooted in process, trust in rules, emotional stability, and the capacity to tolerate uncertainty without reacting impulsively. Losing small plays a critical role in preserving this capital. When losses are controlled and expected, they do not overwhelm the mind. When losses are large or prolonged, they create emotional scars that distort perception and behavior long after the trade is over. The first loss a trader takes rarely causes lasting damage. It is the second, third, and fourth losses, especially when they are larger than planned, that begin to erode psychological resilience. Each excessive loss reinforces fear and self-doubt. The trader starts questioning their ability, their system, and their judgment. Eventually, this internal instability manifests as hesitation, overtrading, or complete paralysis. At this point, the financial damage is merely a symptom of deeper psychological breakdown. Losing small interrupts this destructive cycle before it begins. A small loss is manageable, both financially and emotionally. It does not threaten identity or competence. Because the loss was anticipated and accepted, the trader can process it without internal conflict. The mind remains clear, and the next decision is not contaminated by the previous outcome. This continuity of mental clarity is essential for consistency. Large losses, by contrast, consume attention. They dominate internal dialogue and create an urgent need to recover. This urgency is dangerous. It shifts focus from executing a process to fixing emotional discomfort. The trader becomes reactive rather than responsive. Even profitable opportunities are approached with fear or desperation, leading to poor execution. Losing small prevents this shift by keeping emotional arousal within tolerable limits. Psychological capital is also closely tied to trust. Trust in oneself and trust in the process. Every time a trader violates their risk parameters and allows a loss to grow, trust erodes. The trader may still believe in the strategy intellectually, but emotionally they no longer trust themselves to follow it. This lack of self-trust is devastating. Without it, discipline becomes a constant struggle rather than a natural expression of belief. When a trader consistently loses small, the opposite occurs. Each controlled exit reinforces self-trust. The trader proves repeatedly that they can act appropriately under pressure. This builds a stable sense of confidence that is independent of outcomes. Wins are appreciated, losses are accepted, and execution remains consistent. Over time, this psychological stability becomes the trader's greatest asset. Another overlooked aspect of psychological capital is emotional recovery time. After a large loss, recovery can take days, weeks, or even months. During this period, performance is impaired. The trader may continue trading, but with reduced clarity and increased emotional interference. Small losses dramatically shorten recovery time. In many cases, there is no recovery needed at all. The trader simply moves on. The market does not pause to allow traders to heal. Emotionally, opportunities arise, regardless of a trader's internal state. Those who have preserved their psychological capital are ready to act. Those who have depleted it are either absent or impaired. Losing small ensures readiness. It keeps the trader mentally available for the next high-quality opportunity. Fear is one of the most corrosive forces in trading. It narrows focus, distorts perception, and undermines decision-making. Fear often originates from memories of past pain, especially large losses. When a trader has experienced repeated emotional trauma, the mind becomes hyper-vigilant. Every trade feels threatening. Losing small minimizes the intensity of negative experiences, reducing the accumulation of fear over time. There is also a direct relationship between psychological capital and adaptability. Markets change, conditions shift. Strategies that work in one environment may underperform in another. A trader with intact psychological capital can observe these changes objectively and adjust accordingly. A trader who is emotionally exhausted cannot. They cling to familiar patterns or abandon systems impulsively. Losing small preserves the mental flexibility required to adapt. Many traders underestimate how quickly psychological capital can be depleted. It does not require catastrophic losses. A series of moderate but emotionally unmanaged losses can be just as damaging. This is why consistency in losing small is crucial. It is not enough to limit losses occasionally. It must be a non-negotiable habit. This habit creates emotional predictability, which stabilizes performance. Psychological capital also influences how traders experience winning. After large losses, even winning trades can feel unsatisfying or stressful. The trader may exit early out of fear or over-leverage in an attempt to recover faster. These behaviors sabotage long-term profitability. When losses are small and controlled, wins are processed calmly. There is no emotional overreaction, and profits are allowed to develop naturally. Over time, traders who protect their psychological capital develop resilience. They can endure drawdowns without panic and periods of stagnation without despair. This resilience is not innate. It is built through repeated experiences of controlled risk and emotional neutrality. Losing small is the training ground for this resilience. The most important realization is that money can be replenished, but psychological capital is much harder to restore. An account can be funded again. Confidence, trust, and emotional stability require time, awareness, and often painful self-examination to rebuild. By prioritizing small losses, traders protect the one resource that determines whether they can even use financial capital effectively. Eventually, the trader's relationship with loss changes. Losses are no longer threats, they are safeguards. They serve as boundaries that protect mental clarity and emotional balance. The trader begins to see losing small not as a defensive tactic, but as an active investment in long-term performance. This is why consistently profitable traders are uncompromising about risk. They understand that their edge is useless without the psychological capacity to execute it. They know that every trade risks not just money, but emotional stability. By losing small, they ensure that neither is ever put in jeopardy. In the end, trading success is less about how much money is made, and more about how well the trader can remain aligned with their process over time. That alignment is impossible without psychological capital. Losing small preserves it. And when the mind is protected, the account has a chance to grow, slowly, steadily, and sustainably. Consistency in trading is not built by avoiding losses, but by managing their impact. Losing small is the discipline that protects clarity, dense, and emotional balance long before it protects money. When a trader accepts small losses without resistance, they preserve the mental stability required to execute with precision and patience. Over time, this psychological strength compounds, allowing probabilities to unfold naturally. The market rewards those who respect uncertainty, act decisively, and protect their inner state, because only a calm, disciplined mind can sustain long-term profitability.